Hey, what's up guys? Today I want to make a special video about how I lost money with Alibaba and what you can learn from it so then you don't repeat my mistake. So I think this is going to be an interesting video, so let's dive into it. Thanks for watching this video, and if you have been following my channel, you'll notice that sometimes I mention about the lessons I learned from Alibaba. So now it has been through for almost a year and a half now. I decided to make a summary video so that you can learn from my mistake and how you can potentially avoid making the same mistake in the future. Let's get started. Now, Alibaba is one of the largest companies in China, and it has multiple e-commerce stores. It has Ali Cloud, and it's actually very similar to Amazon in the United States, where there's Amazon Cloud, there's the e-commerce platform with Amazon as well. Basically, they're a conglomerate. And when you're looking at the typical fundamental and technical analysis, during the time I was investing, it was actually fantastic. Then it makes you wonder, well, how did you end up losing money? And in fact, I lost over 100,000 on Alibaba. So that's why I always think a lot about how I could have avoided this mistake and how you can do the same in the future as well. So let's get started. If you go through my free training down below or the free chart course, you'll learn how to get this technical analysis template. So it has a Bollinger Band and two EMAs. So the two EMAs is the red line and the blue line, and the Bollinger Band is this upper and bottom light blue line, which helps you do the technical analysis. So you can see that I rewind all the way back to June 2021, which is almost the time I got into Alibaba. So during this period, you see that the trend for Alibaba is actually quite strong. And you can see that usually it bounces near the red EMA, which is this red line you see here. In fact, I actually entered once near the 2020 December. It went up. I took half of my profits here, so that I made money there. And then I re-entered again when price dropped back to the red EMA. So at this point, then you can see that, okay, it is kind of having a downtrend line. And before skipping ahead, I added more of my position here. Now, if you follow through my program and you kind of understand my thinking process, it's really about understanding why the stock is dropping. So at this point, one of the subsidiaries, and Financial, so that is the competitor for WeChat Pay, is planning to go IPO. And obviously Jack Ma has a lot of shares in that company, so it's supposed to be a piece of good news. But then during the presentation, Jack Ma said something that offended the Chinese government, so then they pulled the plug on Ant Financial's IPO. So this is what caused the initial drop. Now typically, if things do work out, let's say Jack apologized or whatever, then it will continue to go up, right? So if you think about something like Ant Financial IPO, is probably one of the biggest IPO in the world, probably within top 10. So it's going to be a really profitable for all the shareholders, including Alibaba. So this is the Bloomberg News article as of October 19th, 2021, saying that Ant Financial's IPO is stuck in limbo. And this is already a couple months after I invested. So during this period, if I scroll a little bit forward, you'll see that the stock continued to go down. Now, as a value investor, this actually does not change the fundamental view of Alibaba. So the company is still growing 20-30% or more every year. It is still extremely profitable. And when you're looking at all the China stocks, it's probably one of the safest China stocks out there, along with Tencent, JD, Pinduoduo. When you're investing in China, it is a lot more complicated because the accounting standards are different, and a lot of the cultural differences and the way people report stuff are also different, which is why you need to be extra careful. Now, during this time, I was actually working in Hong Kong, and I was traveling to and from China for a couple of years. So to me, as a seasoned investor, I thought I understand the environment quite well. I understand how the government policy drives innovation, enhanced prosperity within China. But turns out I was wrong. And as we go through the remaining news article, you'll get a better feel of how and why I made this mistake. And well, is there anything I can do to correct that? So the next article is that Ant boosts capital to 5.4 billion 1 year after IPO halted. So the IPO actually halted for a lot longer than I expected. At that point, my position is deep in the red. If Ant actually went IPO during this 1 year period, it could have turned Alibaba around, which is kind of what I was hoping for. But it was just dragging on for a prolonged period of time. Now, the next article is that there's a technology regulation crackdown in China. So this is actually something you haven't seen in the US market before. So in US market is very capitalistic. And when you're looking at a capitalistic, companies will go bigger and bigger and bigger and eventually achieving some sort of monopoly status. I have a book here, Peter Thiel, 0 to 1, that talks about that. And in a capitalistic world, the company that ends up succeeding will become monopoly, like Google, Amazon, Apple, so on and so forth. And in China, they issued a series of regulation crackdown targeting like Tencent, Alibaba, to basically prevent them from being a monopoly. Now, initially I thought, well, it shouldn't be that bad. Probably you can pay some fine and get on with it and it will be business as usual. But then this actually led to a slowdown in acquisitions and also a slowdown in hiring and basically depressing the technology market as well. Because the way China works in terms of the technology investment side of things is that a big company will have not a significant, like a minor investment in many different companies. So for example, Tencent might have a small investment in JD, so then they also have a partnership. So then all these technology companies are connected in one way or shape or form, even if they don't have significant control. Whereas in US, you might have a lot more significant control. You buy out the entire company, get the technology, so on and so forth. But in China, they have a lot stronger focus in these minority investments. Now, this crackdown actually decelerates the technology sector, which turns out to be a lot more severe than I expected. And here's an interesting cover from Bloomberg back in the day, where you need to move fast and obey the party. It really goes to show that if you're on the opposite side of the China policy, you'll get burnt badly. Let me just continue forward with Alibaba, and at this point it's 140. I previously entered near 200, so at 140, 150, I still feel pretty comfortable about the position because I think, the chance of it recovering is high. If there's just some good news for Alibaba, it will take it back up. And if you continue forward, it actually end up going to 100. That is another 30% drop. Now, during this period, Charlie Munger, one of Warren Buffett's partner, also invested in Alibaba. That actually gave me confidence to invest in Alibaba because obviously, if I follow, Warren Buffett or Charlie Munger, chances are I will make money. Now, having said that, if you know one of my early investments, I follow Warren Buffett's disciple to invest in the stock, and it ended up going bankrupt in 2 weeks. It's not always positive, even if you follow Warren Buffett. Next article. The regulation is getting more intense, and there are actually a lot of fines being issued to Tencent, Baidu, Alibaba. And this depressed the stock price significantly, and they got hit by these fines multiple times. When it comes to these fines in China, the difference between US and China is that in US, you might be able to appeal it, you might be able to go through the court, but in China, you just accept it and you pay. Or you sometimes even pay a fine even if they have not issued you a fine yet, which was actually the case for Tencent. And when you compare between Tencent and Alibaba, Tencent is more China-centric because their business itself is mainly in China, whereas for Alibaba, it's actually more international. They're actually expanding into different countries in Southeast Asia and Africa as well. Next article. Now, this led to job cuts, obviously, because if you're slowing down in growth, slowing down in acquisitions, then obviously you would slow down hiring as well. So right now, the tech scene in China is not as hot as a result of all these regulation. And obviously, everyone is waiting for China to reopen so then they can enjoy the economic prosperity again. Now, then we skip ahead to the more recent articles, July 10th, 2022, more fines as well. Even though it has been over a year or more since the Ant IPO got halted, there are still more fines. The crackdown is still not over. China is still having a very tight leash on the technology industry, which is obviously hampering its growth. Now, here you can see August 21st, 2022, which is just last week, much closer to where we are today. They're looking to scale back and cut costs. And this, of course, is coupled with the recession problem in China, along with the real estate collapse, and also US dollar becoming stronger because they're increasing interest rates, and China is actually lowering interest rate, which causes capital to flow from China to US, and now they're looking to scale down. So which is very reasonable because if the economy is not good, you can't really scale up anyways. Now, sometimes you'll encounter articles saying that China is thinking about reviving Jack Ma's and IPO as crackdown eases, but these kind of articles get published every couple of months, and so far nothing has really changed. So I do think eventually Ant IPO will be, revived. It will go public in Hong Kong or, Beijing or the Shenzhen exchange, but then there is really no timeline. And yes, we can be hopeful about it, but at this point, I have already exited my Alibaba position, so I actually have no more China stock. In terms of this timeline here, you can see that initially I entered at 200, which if you use the historical price, it was actually a discount. But because of my expectation of the future, I expected the regulation to be resolved quickly. I expected the IPO to come back alive, which both events did not happen to date. And there is also the SEC delisting problem with all the Chinese stocks, which further hamper the growth of the stock price. So in the end, I exited near, let's say, 100. And at that point, I was like, okay, I'm done with Chinese stocks because I realized I don't have a competitive advantage when it comes to investing in Chinese stocks. When it comes to investing in Chinese stocks, you need to know the policy very well. And the policy can change very quickly. And let me give you one of the examples. So EDU, New Oriental Education Technology Group. So this is actually a stock I analyzed within Investing Accelerator, but personally, I didn't know it enough. So then I didn't invest in it. And some people who are more interested in education actually invested in it. And here you can see historically, the stock itself has a very strong trend. It's fantastic. And then you might be wondering, hey, as of mid-March 2021, what caused this giant drop from $190 to $28? And this is actually such a significant drop. It's like over 70% drop. So you need to understand why. It was due to one policy change. If you are familiar with the education system in China, there's a lot of focus on the high school examination in order to get to university. So there is actually a national-wide examination, and a lot of people get additional tutoring to get through that exam and basically get a higher grade. So what this creates is a culture of, cram schools, and you will see that in Korea, Japan, China, very common, where kids are just going to cram school every day to prepare for that exam. Now, in China, they said that these are not good for kids. These additional profit-making tutoring companies should not exist per se. So there's actually more specific wording to that, but that is basically what the intention is. Within 1 year, with just a couple of months, you can see the stock price actually plummeted from the $200 high all the way down to $28. Well, the question is there anything you could have done to escape this loss? And this is actually a question I think a lot for Alibaba here, for Tencent, which is 700 here. During this period, is there anything you could have do to A, minimize the loss, B, avoided the loss, and C, made a profit from it of some sort? If you have been following me for a while, you'll notice that, hey, I like to use options because it allows to multiply my profit. But when you think about this is actually not an option problem. And there's no way you could have invested long, meaning you think the market will go up, buying shares or option that you would make money during this period of time, because the stock continues to go down week after week. Even if there are a couple of weeks that are going up, the stock continued to go down for many weeks. In fact, it was going down for a year and a half. So during this period, you would incur a very significant loss. And this is probably one of the good things about Charlie Munger or whatnot, is that if they invest in Alibaba, let's say at 250, 200, 150, 100, they plan to hold for a very long time, 5 to 10 years. So this is probably getting in at a discount. But for a lot of regular investors like me and you, chances are 1.5 years is already a very long time. And if you're not really seeing results within 1.5 years, then chances are you're going to be exiting that stock unless you intend to hold for 5 years plus. And during that period, when I was holding on to Alibaba, my plan was to hold onto it for around 1 to 2 years at 200. So at that point, I have already reached my maximum duration that I would like to hold it for, and I would rather reallocate it to other companies that are safer, the companies that don't have delisting issues, the companies that are not going to get repeatedly fined by the Chinese government, companies that have a better growth trajectory and are able to continue to expand because there's no tight regulation that prevents them from becoming the number one player in the market. So when you think about all these factors, it is a stock selection problem. So the only way you could have avoided the loss, or I could have avoided the loss, is to not invest in Alibaba to start with. And sometimes those are some of the most difficult decisions that you need to come to, is to not invest in that kind of stock to start with. Because sometimes if I invest, let's say earlier, March 2020, like at this red EMA, I would have made a very handsome profit. But because of the nature of the environment, the policy, even though the fundamental of the company is very strong, the technical also looks like it is at a discount. If there is an overarching government issue, especially for Chinese stocks in China, you're not going to be able to escape the consequence. And I think Alibaba is a perfect example of it. If I go back in time and I can invest in any China stock that I can pick from, okay? Any China stock, I would still invest in Alibaba because it was the number one stock. I wouldn't have been able to avoid this mistake unless I don't invest in China altogether. And I think, yes, there is money to be made when you're investing in China, but you can also see a simple policy can cause, one of the most blue chip stock in China to drop from $300 all the way to $100. Now, I'm probably going to get some comments that, hey, right now it's $100. It's a fantastic price. Shouldn't you be buying it? Because now there's a huge upside from 100 to 300. And that's actually what a lot of analysts or YouTubers will be telling you. But for myself, I've already made the rule of not investing in Chinese stocks anymore because of all the environment, the SEC delisting problem. But one of the good news about this SEC delisting problem is that they actually arrived at some sort of preliminary deal to allow the US Accounting Board, PCAOB, to review the audit documents of these Chinese companies listed in the United States. So this is actually a piece of good news, which is why if you're looking at the latest week for Alibaba, it's actually going up. Now, there are a couple of important points you need to note about this deal. Alibaba is listed in both Hong Kong and the US exchange. And US was the original exchange, and Hong Kong is actually the secondary exchange, but they actually had the option to convert that into a primary listing in Hong Kong and make US the secondary exchange. So what this does is Alibaba is positioning themselves so that in case they ever get delisted by US SEC, they're just listed in Hong Kong. So that means it will either become over the counter in USA, or you can't trade it from US and you actually need a Hong Kong brokerage account to trade it through the Hong Kong exchange. So you can see they're already positioning themselves to be delisted from the US side. And if they do get the deal, great, fantastic, they can be listed in US for a longer period of time. But if they don't, then, well, they are okay in Hong Kong anyways. So this actually puts a lot of pressure for investors to offload their stock and repurchase it in Hong Kong exchange. But if they cannot do that, then they would just exit and invest in something else. And looking at the current market, there's a lot of discounted stocks that are a good value, like Microsoft, Google, Amazon. So the question I always ask myself is, do I really need to invest in this stock? And the answer is, well, I see a lot of other good deals. So why do I need to put myself through that risk, even if there is upside? So I think that is one thing that trips up people a lot, is when you're evaluating risk, you see the upside, right? $100 Alibaba, it might go to 150, 200, 300, or even 400 if you're aiming for 5 to 10 years. So this represents a 4x return, right? But what you need to evaluate is Alibaba as good as some of the stocks you have in your portfolio? And one example of a stock I have is Microsoft. And if I compare Microsoft to Alibaba, it's almost a no-brainer that I want to have Microsoft because I think it's a lot safer. And you don't have all these other issues I mentioned throughout this video. And if you look at my second stock that I have in my portfolio, you would compare it and evaluate if it is better, so on and so forth, compared to the third, fourth, fifth, all the way to the 10th stock. And if it doesn't make it to the top 10, then the question is, well, do you really need to hold on to this stock? And that's basically the summary of the lessons I have learned for Alibaba. And I guess the decision to not invest in Chinese stock is a method of protection on my part. And also admitting that even after working in China for multiple years, maybe I actually don't understand China that well. Because even if I invested in the number one, number two, blue chip stock, this kind of catastrophic event still happened. This begs the second question is, Could I have invested in medium or smaller size company and make a killing with it and get away with it? And I think the answer is I don't think I could have. Now, the next thing I can look at is a couple of other stocks that are also good, like Tencent. So I'm just pulling up the Hong Kong version for you. So here you can see during this period, Tencent, the second biggest blue chip stock, if not the biggest, also went down 50% as well. And then some of my other students were looking at Pinduoduo, and during this time went down 50% or more as well. So during this period, how could you have made money with Alibaba, Tencent, Pinduoduo, Bilibili, or whatever? And their answer is you couldn't have as a traditional investor. Now, if you are using options and you decide to short the market, then I think, yes, you can make money if you start buying puts on these companies during this period of time. But for myself, I am a long-term investor and I'm mainly bullish. So I focus on discounted stocks that are already cheap. So I'm not really a big fan of shorting the market, even though you can make money when you're shorting the market. And one of the downside I find when it comes to shorting the market is that people easily get confused on the real direction of the market. Some people, they short the market too much, and then the market turns against them and start going up. Some people, they just short the market, so they continuously look for weaker companies to short the market. But some people, they don't know how to pick these companies, so they end up choosing really strong companies to short the market. So this is really the summary lesson for Alibaba and what I learned over the last 1.5 years. So as you can see, I'm not perfect. It is possible to lose money when it comes to investing. And every time you lose money, you make sure you want to self-reflect and figure out how you will not make the same mistake again. And during these volatile times, it is very important to protect your portfolio and select really safe companies to invest and potentially at a discounted price if you're able to. And I think that will give you the best long-term protection and long-term growth overall. And if you always have a long-term view in mind, then you will be able to ride through a correction unless the company you selected is not good to start with. So yeah, let me know if you have any comments. And if you're interested in learning more, I'll include the free training link in the description below. And if you're interested in being part of the program, then you can schedule a call with me and have a chat. I'll see you in the next video.